Hi all! Today we continue to introduce our investment barbell strategy. We will dig deeper into the IBS and explore how to spring to financial success. My name is Jeff Hewlett. I'm a decision confidence builder. I'm a behavioral economist and have been in banking and financial services consulting most of my career. I'm also a faculty member at James Madison University, and I'm a personal finance author. As a reminder, here's our financial road. We have many investments and important decisions as we travel our financial life. Here are the 4 agenda items for our investment barbell strategy. Today, we're going to explore number 2. We will more deeply define the IBS and show you how to implement the IBS. As a reminder, we will start with where we left off before. Let's discuss the 2 essential risk features, diversification and volatility. Diversification is the degree to which an investment component, like a company, can impact the overall value of an investment. The more companies, the higher the diversification. Volatility is the degree to which an investment varies above or below the average value of that investment. The more the investment varies from the average, the higher the volatility. 2 risk features create 4 quadrants. Those quadrants are at the end of the diversification volatility risk barbells. The 4 quadrants are called cash, robo, real, and fun. These heat-related colors are inclusive of both risk and return. So for risk, green is the lowest risk and the lowest return. But then red is the highest risk and highest return. As an important guiding principle, our objective is not to eliminate risk. Let me repeat for emphasis. Our objective is not to eliminate risk. Our objective is to seek appropriate exposure to risk and eliminate ruin. This investment barbell strategy is devised to help you maximize your risk-adjusted return. This is done via exposure to all 4 quadrants. While the strategy will not eliminate risk, it will eliminate ruin and maximize your return. First, let's summarize the 4 quadrants. 1, green, well-diversified and not volatile. Mostly cash, bank deposits, and low-risk liquidity investments. This quadrant is mainly managed in our savings waterfall we discussed earlier. 2, yellow, well-diversified, and highly volatile. These are mainly robo-advisors or related diversified portfolios. This includes regular rebalancing and tax-efficient strategies. 3, yellow, not well-diversified and not as volatile. This is primarily real estate or REITs, R-E-I-T. This is like your home or investments in a portfolio of real estate. And then 4, red, not well diversified and highly volatile. This is individual projects like stocks, partnerships, business ventures, and target sector investments. The barbell tactics are to deploy our investable equity at the 4 corners of, or the 4 bells of these 2 features. Now, what are leading academics and investors saying? So, author and former bond trader Nicholas Nassim Taleb said, one may be risk-loving, yet completely adverse to ruin. In a related comment, legendary investor Warren Buffett said, don't test the depth of the river with both your feet. Then, as a guiding principle to implement the IBS, Nobel laureate Richard Thaler said, there is growing evidence that most people would be better off not paying attention to the ebbs and flows of the stock market. Next are the percentage targets for each quadrant. As you would expect, cash is pretty low to handle your waterfall liquidity and unexpected opportunities. Robo and Real have the dominant share. This is where you hold your anchoring financial and real estate investments. Finally, the fund quadrant has most risk, but it's also governed by a lower percentage exposure. As we discussed earlier, the right way to invest is to vary the proportions across higher or lower risk quadrants to average your overall risk performance. The wrong way to invest is by requiring all your investments to conform to your overall risk preference. Also, this guideline is flexible as to the life stage. So for example, a younger person, maybe they're in their 20s, maybe they're looking at their first house, but they may have more investable equity in real estate when they buy their first home. So in this example, quadrant 3 may be at high end of the range. So remember, progress, not perfection, is our mantra. Now, let's dig into some of the specifics of each quadrant, starting with cash. That's quadrant 1. These are bank deposits, payments, and liquidity, usually low interest bearing, even sometimes no interest for your demand deposit accounts or your regular checking account. You can use money market mutual funds. This is essential for implementing your savings waterfall. Moving around the horn, next up is Robo, which is quadrant 2. A SEP IRA or some kind of retirement account, such as a 401k or a thrift savings plan in the government. So these are tax advantaged with a couple different flavors called a Roth or a traditional. Robo-advisors are a managed account. They are low cost, diversified, regularly rebalanced, and use tax loss harvesting. The good news is you don't really have to know any of those things. You basically just need to know to sign up for the account and to basically feed it with regular automatic deposits. The typical investments are in ETFs or mutual funds, which hold portfolios of individual investments. ETFs are less expensive, which is good for the IBS. So moving along to real quadrant 3. Housing has utility as the place to raise our family and make a home. Even though the U.S. tax code does periodically change to reduce some of the tax benefits of home ownership, it is still an amazing deal. In fact, I estimate the value of home ownership, and especially not renting, or in other words, the opportunity cost of renting, to be at $9 million for retirement. Investment properties and REITs are alternative ways to participate in real estate. Entrepreneurs may wish to invest in commercial real estate for their business. And then finally, quadrant 4. This is fund money or capital at risk. Investable equity exposed to higher volatility and higher diversification risk. Key operative risks are systemic risk and idiosyncratic risks. So those two kinds of risks, they're not so important, but thinking about which kind of risk you're going to take in terms of whether you're going to buy individual companies or whether you're buying some sort of or applying your equity to some sort of target investment account, that's where that'll come in. I actually have a lot of information in my book about that, but don't worry too much about it for now. So finally, trading accounts and target investment strategies are used for execution of this strategy. Finally, there are lots of ways to get started. In my book, Making Choices, Making Money, I offer decision tools and many suggestions to implement the investment barbell strategy in your life. Now, let's switch gears. I'm going to tell you a story as a setup to what's called spring investing. So buying something new is a normal part of life. We also want to be confident we're getting a good deal, especially when making a significant purchase. Let's say you need a new car. Your old car is getting on in years. You know it is probably just one more big mechanic's bill away from costing more than it's worth. You have some time to consider your car options. You look on car websites and find the year, make, and model car you want. Whether you want a new car or a used car is not really important for our story. The key point is, through the process of clearly defining and weighing your preferences, you have found several cars that work. So now you wait. A few months later, one of the cars you're interested in goes on sale. It is now 25% less expensive than all the other cars. You're excited. You're glad you waited. You feel pretty smart. You go and purchase the car at a healthy discount. You're feeling good. You're feeling confident. You're feeling successful. Yay. And that's a big yay. The point is, you should feel exactly the same way when investing in down markets. This is important. You should feel the exact same way when investing in down markets. If share prices go down by 25%, you should feel great about buying more at this healthy discount. But do most people? Actually, they don't. Most people, when they see the markets go down, feel scared. 50% of people will not even invest any money. Many others get scared out of equity markets at exactly the wrong time. It is natural, but it is wrong. And that's exactly what our investment barbell strategy is here to help you manage. And it will help you manage. When the markets go down, it improves your opportunity to buy balanced equity portfolios at a lower price. The notion is to average down your portfolio basis using a time-tested technique called dollar cost averaging. Think of this like a spring. So when you compress a strong spring, you are trapping energy in its coils. Once released, it will give incredible momentum to anything sitting on top of that spring. The US and global economy is a strong spring. Thus, load up your compressing investment spring with a well-balanced equity portfolio. Once the market bottoms and the spring is released, then watch your investments fly. So next time, we will dig into more details for implementing the IBS. But until then, you've got this.